Bergman Beving Q3 report. In these small quarterly updates, I will look at the most important numbers for the company, as well as the share price in relation to the numbers. Also, I will highlight any news or changes which might affect my long-term opinions about the stock. As a consequence, each quarterly update might not focus on the same things, as different measures are important for different companies. Also, some episodes might be longer than others, depending on the report. I will try to not go above 5 minutes per episode for any of the quarterly updates, in order to respect the listener's time. Bergman Beving is one of the OG serial acquirers. They are led by a very competent CEO with focus on returns on tangible capital, shrinking underperforming businesses, and with a tried and tested playbook for M&A. In my first episode about Bergman, I stated that I found the company a bit too expensive for my estimations about future growth and returns. This is because of quite slow organic growth and an initial free cash flow yield of around 6%. Since then, the stock is down from 300 to 280 SEK per share. Looking at the Q3 report, the company showed negative revenue growth of 1%. Organic growth was a positive 4%. Despite these headline numbers, EBITDA increased 12% due to a solid margin expansion from 9.6 to 10.7%. Two small acquisitions was announced in the quarter, adding 75 million to the top line, compared to 2024 revenues of 5 billion. Profit over working capital went from 30 to 35%, moving towards the long-term target of 45%. This is the profitability measure used within the Bergman Beving family, which has contributed to the strong historical returns within the family. The negative revenue growth is due to divestments of underperforming assets and should be a welcome sign to investors. Growing revenues is not difficult, but growing profitably and capital efficiently, that is difficult. The CEO is in the midst of turning around the legacy assets to focus more on return on capital, but Rome is not built in a day. In my opinion, the headline numbers from the report is solid and things are moving in the right direction. However, the valuation is still a bit lofty to me. In my initial episode, I stated that a 20 to 30% haircut in the stock from 300 was warranted. This take has not changed. The company and CEO needs to keep doing what they are doing, and they are on the right path. The stock price, however, prices in pretty high expectations for either organic growth, margin expansion, or returns on incremental capital. With my expectations, the share price is still too high, around 280 per share. With a fall below 250, the stock may become more interesting. In order to respect the listener's time, I would not make these small updates longer than they need to be. If you believe these updates to be too short in order to bring any value, then please let me know and I will adjust accordingly. Thanks for listening.